Yeah? Hello and welcome to yet another episode of the CNBC TV 18 Investor Camp. We are here in the sweltering heat of Delhi. It's not just hot in the city, but the heat is on in the markets as well. For the last couple of weeks, the market has been tepid, very subdued. But you know what? We saw a good relief rally on Friday, and the cash market volumes on Friday were the highest ever that we've seen. So is this the start of a turnaround, and is the worst over in terms of the correction? Well, all that and more will be lined up in the next 2.5 hours. We have an expert panel here who's with us as well. And Udayan is also here with us. Hi, Udayan. Morning.
Hi.
It's very, very hot here in the city, but very hot in the markets these days as well.
I don't know how people live here. I'm amazed at how people
You
live
used to live here once.
I know, I've forgotten. I used to do many things earlier. But, yeah, it's very hot in the market, but it's gone a bit cold over the last few weeks. But what makes me very happy is that domestic investors are doing something very different from what foreign investors are doing, for a change. For one reason or the other, FII flows have dried up a little bit, but Indian investors have not panicked at all. In many cases, their mutual fund NAVs would have gone down about 15% when the Nifty came down to 8,000. And I was looking out for some telltale signs of some panic creeping in, because the confidence that domestic investors have towards equities is a very newfound confidence. It's only been there over the last 9 to 12 months. Before that, domestic investors, Indian investors gave equities the pass for almost 6 years. And then to come back and then to be stung by a 15% drop, you could have panicked, but investors did not panic. I like that a whole lot. I mean, time will tell whether domestic investors are right or FIIs are right about India. But I think this is a temporary patch that we are going through, which we'll come out of. Was Friday the turning point? I'm not a big technical expert. You would need to ask Sudarshan that question. But I would think that it is too early for a turning point here, because there are lots of fundamental things which are stacked against the market at this point. That doesn't mean that the market cannot go up against those fundamentals. But if the market were to build on Friday's rally and, say, rush to 9,000 plus immediately, my own sense would be that the market would be getting ahead of itself. Because there are many things which are going well for India at this point. But I think some of the key things which are required for valuations to expand are not in place at this point. Now, we can scoff at them saying, don't stop all this boring talk about how valuations cannot be more expensive and how earnings will need to catch up. They may sound boring, but finally the market is about those things, earnings and valuations. However much you want to talk against that, markets will finally come around to following those. And I think those things need to catch up a little bit. So my own sense is 2016 is probably the year where everybody will be in a far happier frame of mind. Within that, I think you will have good periods and bad periods. Sometimes you'll be at 9,000 as you were early in the year. Sometimes you'll be at sub 8,000, which also you saw a few weeks back. And there will be volatility within that. But I think that clean run which we saw in 2014, my guess would be that that would happen again in 2016, not this year.
Okay, so this year it would be a little patchy. But since you said that, there's a lot of confidence that has returned to the market, let's just do a dipstick survey. Let's find out. We have so many savvy investors here. How many of you have actually made money in the last 1 year in the market? Not bad. And how many of you have lost a lot of money in the last 3 months? Not too many. So we still have a lot of people making money in this market. How many of you are confident that the market will continue to move higher? So the confidence is aplenty. You called it right.
I don't know whether that's a good thing or a bad thing, but you could read it.
Hope that doesn't get betrayed.
Too many hands up in a bullish way sometimes scares me a little bit, but I think this is a good confidence. I am with my hands up as well. I think people will continue to make money as long as they have that maturity. Too many people start panicking the moment there is a 10% correction in the market. You need to see far greater evidence. The market has gone up from 5,000 to 9,000. You've had a 10% correction after that, 12% correction after that. and the word bear market comes out of the kitchen closet. You already started few people saying, maybe the bull market is over. I overheard one of your guests saying that maybe 3 weeks back, a Delhi gentleman too, I won't name him, saying, forget the bull market, it's over. It was good while it lasted, but it's over. You know, you can't be that immature.
No, he told me he woke up on the wrong side of the bed that day.
Yeah. So, you know, I don't think we've seen enough evidence to suggest that the market has turned for the worse in a decisive manner. Can it happen? Anything can happen in the market. Today we are bullish. 3 weeks later, something else might have happened in the world and we'd all speak in a different tone. So in the market, you can never be sure. But right now, this looks like a classic 15-20% kind of a correction, which happens regularly in bull markets. It doesn't seem more vicious than that. And it's led by something which is not an accidental surprise kind of a trigger. You know, all of us have been talking about weak earnings for 3 years now. We are waiting, earnings are not coming through. It's not something which we woke up to suddenly this morning. So it's frustrating us. It will continue to frustrate us for another couple of quarters. But usually these kind of triggers will not lead to a complete meltdown in the market. It will from time to time lead to periodic adjustments, which is what is happening. Some stocks have run away to 20 PE. Earnings have not come through. It will slowly come back to 16, 17, 18 PE. That's a regular orderly correction. This is not a disorderly kind of correction that we've seen. The markets has merely cooled down because of lack of earnings conviction and high valuations. Now if something else were to happen in the world where we can't predict some unknown were to hit us, and for that a lot of money goes out of India. Now that's a disorderly event. That can lead to the market going down a whole lot. But we are not there today. We don't know what the cause could be. So we always remain vigilant for those things. But the nature of this correction, I think, is more of a bull market correction rather than the onset of something far more venomous than that.
Okay, so since this is a bull market that we are in, sectorally, how does one approach it, Udayan? Because, you know, there's a lack of leadership now. If you look at technology, it has problems of its own. Consumption is slowing down. Rural markets are slow. There's not, PSU banks are a whole different ballgame. So where do you look for leadership now?
You know, 1/3 of the index is banks. If banks don't lead, markets don't go up. You cannot have a situation in India because the index has become so heavily loaded with financials that it's very difficult, near impossible for the market to make new highs with banks underperforming in a major way, particularly if IT is not playing along. IT is going through a rough patch. Banks plus IT is more than half of the index. So when you look at the index and you say, I want leadership, and we say banks won't do it, and IT won't do it, then what will do it? So from an index point of view, financials have to lead all the time. But I think from an investor's point of view, the question probably should be, if this is a difficult phase, and I want to be accumulating in this difficult phase for 2 quarters now, because investors are not chartists. Chartists thrive on strength. Investors should thrive on corrections. Investors should not be chasing breakouts in the market. It's fine. You can make some money for a while. But I think the next 6-9 months is a great time for investors, particularly if the Nifty does not go anywhere. And you keep getting repeated forays into that 8,000 kind of zone, which means that a lot of stocks are 20-25% off highs. You need that. And once you get that, and you're betting that 2016-17 is going to be a good time for the market once again, I think it's time to be a little brave at this point. You know, all of us know private banks are great. All of us know a few pharma stocks are doing great. But you need to have a little bit of a contrarian bone in your body to make serious money. You know, these are all crowded trades. They will continue to do well. I'm not saying private banks will not do well. They probably will be huge money makers over the next 3 years. But could something give you 3-4 times your money, 4-5 times your money? I think for that, the sectors which people don't like very much, and I would include public sector banks in that, you know, it's about the most hated sector in the market at this point. For good reasons. It's not doing well. But say interest rates start coming down in a more accelerated fashion in the next 6 months, which is conceivable. Say things turn for the better from a domestic cyclical point of view, industrial point of view. CapEx starts picking up. This is a brave call. But I think a State Bank of India can double by the time 2016 is over. It can very easily happen. Nobody wants to buy it right now. Everybody wants to buy Yes Bank. But Sorry, Yes Bank is a sponsor. It's a great bank.
No, it's good. Why are you saying sorry? I mean, it's direct promotion for
the
them.
joke was lost on me. It was not intended at all. Yes Bank is a good stock. But I mean it.
You're going to be getting a lot of calls from them.
No. Rana Kapoor is a very mature man. I've had my skirmishes with him in the past. But, as I was saying, SBI, it's the classic stock. I'm not saying it will go up in the next 3 months or 6 months. It will probably continue to frustrate people in that 270, 280, 270, 280. But these stocks have a habit of turning around dramatically and giving you big returns. You just go back and see the last high which SBI had when the market was on a tear in 2013-14. I think it will effortlessly get back to that at the first sign that the asset quality cycle is beginning to bottom out. It is just an example. I'm not saying SBI is a stock you need to buy tomorrow. All I'm saying is move out of that safe haven of private bank plus pharmaceuticals and probably load on a little bit of risk over the next 6 months onto your portfolio. There are lots of industrials which people don't like very much. It's only in the last 3-4 months people have started talking about Crompton Greaves despite poor numbers, a Voltas, a Cummins, an IRB Infra. But I think some of these industrial companies, when they take off, they will make you so much money that you'll blush.
But the question is when, right? Udayan, I mean, 6 months back, we were saying that 6 months later, the capex cycle will pick up. And in all honesty, if you had bought some of these PSU banks at the start of the year, your wealth would have been eroded by about 20-25% in the first 5 months. So should you still have patience?
This is all of us know Rakesh Jhunjhunwala. And all of us like to be like him. Saying we want to buy the same stocks, we want to make so much money. And I was having a chat with him last evening, and he said something interesting. He said, all of you know how much money I made from Lupin. But do you know that in the 12 years that I've owned Lupin, I've gone through phases of 3 years at a time when Lupin did not go up 1%. That is where you make money. Your conviction is so strong that you take 3 years of underperformance, but don't ditch the stock. But we have become so short-termist that 3 or 6 months of underperformance relatively to your portfolio, and you say, this is not a good stock, chuck it. Then you make 10, 15, 20%. Then you make what the Nifty is making. But then you don't make those multi-baggers which you want to make. You have to be patient. 1 year is nothing in your horizon of investing. Hopefully, you get in for a 5-6 year cycle. You don't make money for 1 year, it's fine. This year is a tough year. People will not make a lot of money. Last year was a great year. People almost doubled their money. Maybe 2016 will be another great year. So I think this kind of short-termism which has crept into the market is a big enemy of the investor. Big enemy. And I think we've all played our part in it by feeding this buy today, sell day after tomorrow, make your 6% and run away. The serious money is made. It's a cliche, but the serious money is made by being a little patient with your good quality stocks and holding them over a period of time. Everybody in the room knows it better than I do, but sometimes we forget that because the excitement of making money in a week is such, it's overpowering.
So did he tell you what the next Lupin is going to be?
He never tells me all these things. Would I be standing here if he did?
Okay, you spoke about PSU banks. So what are the other pockets of value in your mind?
Ignored autos. Everybody owns Maruti. There's no fun in Maruti any longer. It's a discovered stock. It'll still make a lot of money. It probably is the best stock in the sector. But I think there are some stocks in the auto sector where valuations have not expanded to the extent where it could. I'll give you an example. Again, it's a stock which is a tricky one. It's gone up a lot, but Ashok Leyland has come back to about 70, 69 kind of levels. If the market corrects some more, maybe you get it at 60 rupees. You've seen Tata Motors numbers this time around. After a long time, the domestic business seems like it's kindling up. I mean, the JLR ride has faded and now the domestic business is beginning to slowly claw back. That's very hopeful for Ashok Leyland. If the CV cycle turns around through 2016 and 17, which is very likely, I think Ashok Leyland could be a 250 rupee stock over 2 years. At the end of 2017, valuations will look obscene if you put the numbers today, saying, are you off your head? How can Ashok Leyland be 250 at this car? P multiples will be 200. But the CV cycle magic is such, the economies of scale are such that when it starts generating returns, the earnings go up from 1 to 100. So again, it won't happen in 6 months. You'll probably get 1 or 2 bad quarters again before the good turn happens. But it's an example of a stock which is perched at a point where maybe the dark road is just 6 more months, and then the up road is probably 3-4 years. You could make a lot of money from those kind of companies. But I'm most bullish on industrials because I don't think valuations have started moving up in the real industrials, and by that I don't mean only L&T. There are many companies in that segment where I think you could have explosive growth through 2016-17, where earnings will multiply, not just grow at a compounded rate of 15-20%. So I think these kind of surprising earnings stories attract me most over the next 6 to 9 months. I would be patiently waiting to buy those kind of pockets, not these same old Axis banks, I didn't say yes, ICICI Bank and Maruti. You know, all of us know they are good companies and they are must-holds in your portfolio. But I think the second half of 2015 belongs to a little bit more homework and a little bit more risk-taking. My own sense is that this is probably the last time you'll get to buy stocks at reasonable valuations. It's a brave thing to say, but I think the lows of this bull market probably get made over the next 6 months. And that low I don't see violated in 2016 and 17. So it's a brave call. I could be wrong. But I think this is the next 6 months is the time for a serious investor to go out, stick his neck out, be patient, take a few blows, no problem. Lose 8 to 10% on your NAV. It doesn't matter. 10% of a cut on your portfolio for an eventual 3-bagger or 4-bagger, I think is a very, very acceptable risk reward.
You know, before I toss across to Nilesh or invite him on the podium, this market has been doing a lot. I mean, at least the savvy investors have been doing a lot of homework. If you look at this earnings season as well, a lot of high pedigree stocks have been giving good returns after exceptional numbers, whether it's something like Britannia, whether it's UPL, Amtech India, Dish TV, Aisha Motors. The list is endless, you know. So do you see a lot of opportunities in the mid-cap space? I know a stock that you have spoken about in the past was Glenmark, and something that has delivered great returns. But in the mid-cap space, are there any more of these, you know, interesting pedigree stocks which still offer value?
Plenty. You just need to be careful about one thing, Sonia. The nature of this market is such that whichever mid-caps are delivering good numbers, their valuations are very expensive because the market is so focused on quality, and that's a very good thing, is that people pounce on a stock which is delivering good results and take it up to 30p immediately. You will not find the stocks that you're mentioning at reasonable valuation levels. So if I were an investor, I mean, if you own those stocks, keep holding by all means because they're showing excellent earnings momentum at a difficult time. This is a difficult time for most companies. And companies who are reporting good earnings at such a time, those are companies you should be owning, so no argument with that. My own sense is, if I were to start a portfolio today, I would say split your money 50-50. 50% you buy high quality blue chips. You buy your Marutis and your ICICI banks and your Sun Pharmas because you need to sleep well at night. You need a core portfolio. You cannot just be playing risk with 100% of your money. The other 50%, I think you need to spread between the kind of companies that you mentioned, but also the kind of companies which are very good companies, which are going through a difficult period at this time. My only sense is the difficult phase is your friend as an investor at this point. And that point I labor again and again because people have become so earnings and quality focused in the market that they forget that companies with 20-25 years of very good pedigree and track record, which are going through a bad phase, they should not be overlooked completely because this, as they say, form is temporary, class is permanent. The Voltas and Cromptons of the world have delivered returns for 30-40 years. They're going through a bad phase. They will come out of it. You need to be owning those companies because you're getting them at reasonable valuations. The good mid-caps you mentioned are not available at very good valuations. So mix it up a little bit, and I think you need a little bit of risk at this point. Just don't be too earnings focused because at this point of the cycle, a lot of earnings and a lot of companies will look terrible to you because earnings are not there. But they will change next year, make no mistake. And if they don't change next year, you can kiss this bull market goodbye.
Okay, take some risks. As they say, fortune favors the brave. But on that note, let's invite our first speaker and a very interesting discussion lined up ahead. He's market veteran Nilesh Shah of Kotak AMC. Please put your hands together for him.